three things drive the stock markets: valuations, growth in earnings, and liquidity. Currently, while valuations are attractive and expected earnings forecast is also positive, liquidity drying is one big highlight for this summer of 22, which is making a value-conscious mindset. So highlighting this fact that the summer of 22 brought in value-conscious markets, the next panelist will discuss on how this shift will change the future investment strategy. The panelists for this discussion are thought leaders and industry veterans, and I'm so pleased and honored to introduce them to you. We have with us Mr. Prashant Khemka, the founder and CIO of White Oak Capital Management. Prior to setting up White Oak Capital Management in June 2017, he spent 17 years at Goldman Sachs Asset Management and also for the global emerging markets. He has won several accolades as the CIO and lead PM of GS India Equity, and he and his fund has won several awards, including AAA rating from CityWire and elite rating from Fund Caliber, amongst others. In addition to his long-standing India investing experience, he brings a unique perspective derived across developed and emerging market equities and has successfully managed US and global emerging market funds for leading institutions during the last 2 decades. We extend a very hearty and warm welcome to him. We have with us Mr. Raamdeo Agrawal. He is the chairman and chairman of Motilal Oswal Group, ladies and gentlemen, an awardee of Rashtriya Samman Patra by the Central Board of Direct Taxes. Mr. Raamdeo Agrawal is the chairman of Motilal Oswal Financial Services Limited and the driving force behind the company's approach to investing. Mr. Agrawal has created the QGLP, which is Quality, Growth, Longevity, and Favorable Price Investment Process, and its buy right, sit tight investing philosophy. He has been authoring the annual Motilal Oswal Wealth Creation Study since its inception in 1996, an associate of Institute of Chartered Accountant of India and a member of the National Committee on Capital Markets of the Confederation of Indian Industry. He has also been featured on Wizards of Dalal Street on CNBC TV 18. We extend a very warm welcome to Mr. Raamdeo Agrawal. We have with us Mr. Bharat Shah, ladies and gentlemen, who is the Executive Director of ASK Group. He is a qualified rank-holding chartered accountant, cost accountant, and MBA finance from IIM Calcutta, having topped the class in finance. He has over 30 years of experience in the Indian capital markets with deep interface in Indian corporate world, and he represents comprehensive insights in Indian capital markets with strong emphasis on bottom-up investment philosophy. He has considerable understanding of global businesses, and stock picking is his special strength. The investment philosophy emphasizes buying only quality businesses, enjoying superior growth, but at reasonable valuations. We extend a very warm welcome to Mr. Bharat Shah as well. And with that, ladies and gentlemen, this session will be moderated by Mr. Kamal Manocha, who is founder and chief executive officer at PMS AIF World. He is responsible for driving the overall business across both wealth management as well as content management. And over the past 3 years, PMS AIF World has indeed conceptualized various innovations under his capable thought leadership, the most recent one being the quality, risk, and consistency framework created to deep dive the space of portfolio management services. Now, Mr. Manocha brings with him 18 years of experience, holds a master's degree in management, a bachelor's degree in economics from Hansraj College, Delhi University. With that, once again, a very hearty welcome to all our eminent panelists. And now it's over to you, Mr. Manocha.
Thank you so much, Aishwarya. It has been a great beginning to this panel discussion, and welcome everyone. So before we begin, I would just like to give a context. When we started off this platform, PMS AIF World, in 2018, we had this firm belief that whenever there is a darkness, the only light is knowledge that can actually help us sail through that period. And soon after we launched our platform, Indian economy was kind of seen into some kind of a turmoil. And then there was an event which was COVID. And now again, after 2 years of seeing liquidity-driven market rally, we are back to a macro-oriented risks, where again, there is a kind of a darkness. And that is where we are just trying and making endeavor to understand from these thought leaders. And it is my delight, and I'm honored to get from the wisdom of some of these thought leaders. So, I'm trying to again give one more disclaimer that I'm trying to moderate this panel from the context of realistic questions asked by investors, because this is the investors event, so that we are able to add the realistic value. So the very first question that comes to my mind from Mr. Prashant Khemka during current times is that we have seen, of late, over last decade, various fund managers, including Mr. Bharat Shah, who are proponent of the fact that when it comes to investing into equities, it is a very, very selective set of businesses where one can invest. So, Mr. Bharat Shah goes to say that when it comes to selecting a company, it is basically a combination of not only a business, but an industry and people, and then those people who are ethical as well as capable of taking right, allocation decisions. So obviously, it is a very, very complex mechanism, and hence finding, many businesses which fulfill this criteria is absolutely impossible. So hence the set is very, very selective. And for last 1 decade, that selective set oriented approach has actually worked, because market was going down and economy was going down, and we saw those times. Now at this juncture, for next decade, does the same, thought holds true? I'm asking this question to you, Prashant, because your portfolio, is diagonally opposite, because your portfolio has 50 to 60 companies. So that is the reason, I thought I should, ask this question to you. Over to you.
Well, thank you, Kamal, and thank you, Aishwarya, for the introduction. You made it difficult for me, Kamal, by having said that this is Bharat Bhai's approach. So I certainly very much admire Bharat Bhai, and so Bharat Bhai has several aspects to his approach, right? And this is certainly one element of those various aspects. And if you think about how we do, is not even on this count, need not necessarily be too different. See, we are also very selective. You can have, for example, 20 names from the top 200. I'm just taking numbers, not necessarily factual, but I'm just saying, let's say you have 10, to take extremes, you can have 10 stocks selected from top 100 names, or you can have 50 stocks selected from top 500 names. The selectivity ratio is the same in some sense, right? You're selecting 1 out of 10 names. So the reason we have a larger number of names in the portfolio is because our investment universe is far larger. We have, I think, over 500 names in our investable universe. The selectivity is very much similar. And then obviously, the team is structured in a manner so as to be able to research and identify investment opportunities over a larger universe. So a lot of, which is the appropriate size of the portfolio and universe is a function of several things, including what I just said, and also how the structure of how the team is structured, I would say, Kamal. I hope that explains what I'm saying. We do have a considerable investment in fairly small cap names because of the investment universe being 500 names, because as per SEBI definition, large and mid caps themselves make up something around 150 names or so. So we do venture out in the small caps as well, where we take fairly small position sizes. I hope that explains, Kamal.
I must say, that over last 1 year, when we have seen a phase of correction, your well-diversified approach has actually relatively helped you in terms of, you kind of protecting the downside. So now moving on to Mr. Bharat Shah, I am a great admirer, of all your webinars that we have done, that you have been doing otherwise outside. I think, you yourself are a wealth of wisdom. So my, question to you, Mr. Shah, is that last Diwali, when we had done one episode with you, at that point of time in the month of November of 2021, you had kind of summed up that webinar by saying that you believe that we are at a cusp of a greatest bull run. And you also mentioned that, the wealth creation opportunity in the future lies in the hands of in the hands of patient and long-term investors. Absolutely, we understand that and we kind of abide to that. But there are many investors who have been kind of fortunate or unfortunate, who actually invested a peak of last bull run around October, November, December. And today, when the portfolios are down again, 15 to 18%, they are of the view that maybe, they have taken a wrong timing. They are long-term investors, but we need to kind of, address their concern. And also want to understand from you, is your view that you had given in November intact? And what are your thoughts in this regards?
Yeah, thank you, Kamal, for all the nice words. My view is even as strong, if not stronger, than what I mentioned. I don't exactly recollect what I might have said this, but if that implication is that the period ahead is one of the greatest periods for wealth creation and value creation, I absolutely think so. I think India is a country, India is an economy, India is a society, is slated for not just a leap ahead, but a huge leap ahead. This is not short term, it's long term, it's not minor, it is substantial, and this change is not shallow, it is deep. And therefore, wealth creation opportunity is not something of a piffing variety, it is huge. And unfortunately, human emotions are far too centered around past or immediate past or present or what you are dealing with on a moment-to-moment basis. But investing is exactly opposite. The immediate past and the present imbue your thinking with too much of emotionality. And good investing is all about taking your mind away from the dance of the market, but completely remaining focused on where the opportunities are lying and whether those opportunities are sensibly priced. And in that battle, a 10% or a 15% or a 20% or a 30% change, time to time will come. Fewer occasions, but some occasions will present you with rude, even 40% kind of a change, which may be very unpleasant one, but time to time, less frequently, but will occur. And relatively rare, but deeply distressing, even 50% kind of changes, people have to be prepared. But if that takes away oneself from the task and to remaining focused on the long-term objective rather than short-term kind of a tactic, then I think, unfortunately, psychologically, one is not prepared for investing. And to that extent, whatever else may be the other skills of investing one may have, but psychologically or emotionally, one may not be equipped to handle the work on a longer term basis. So I believe there have been deep changes which have been brought about in the character of this country over last 5, 6, 7, 8 years. And some of the changes are combining together to build up a crescendo. Some more changes are in the offing, and some of the changes will take some more time to kind of reveal their hands. And is the interacting cycle of these changes works with each other? I think we are hitting a virtuous cycle. If rude COVID wouldn't have interrupted, this would have been accelerated. If the war business and many of these disturbing macro events in the world wouldn't have occurred, again, this would have been accelerated. But that said, however large these macro events and others look like, in any case, I think they are noise. And it is not going to take us away from the long-term objective. And if I dare say, not that I know too much about it, I'm in some sense a frog in the well. So my focus and attention is on India. Whatever little I understand in the context of India and Indian opportunities. But I believe, and the record also would show that most parts of the world do not have really markets or economies which represent a symphony of the two enough for one to make credible long-term returns. Europe, I think, is in a state of deep freeze, if not deep decay. Japan problems are well known. China, I think the businesses are getting torn apart. Latin America is hardly a geography with too much of violence and volatility for one to be an investor. America has its own problems, but still, that is one market which represents innovation and entrepreneurship. And if I dare say, only other market which offers credibility to my mind on a long term is India. So really speaking, from the vantage point of New York and London and many other such centers, a lot of global strategies may be crafted, but I think really speaking on a long term, there are barely any choices available of size, substance, quality, character, and magnitude. And therefore, more than ever before, I believe wise and careful selection, controlled psychology, which is not immediately impacted by the violence and ups and downs of the market, but remains focused on the job, and willingness to keep adapting to the new insights and the new learning which markets invariably throw up. If we do that with prudence and remaining focused on quality with long-term mindset, unprecedented amount of wealth and the value creation opportunities in this country today.
Sure, Bharat Bhai. Thank you so much for such an elaborate answer. Raamdeo ji, I'm moving on to you. So, the topic of this panel discussion is that after the recent fall that we have seen over the last 9 months, where growth businesses have actually corrected a lot. And as when Aishwarya, our host of this event, introduced this session, mentioned that there are 3 factors that kind of determine the future of equities. One is growth in earnings, second is valuation, and third is liquidity. And third factor, liquidity, which is actually changing the context of present and future. And if I give you, some numbers, last 5 years, the returns given by, for example, Asian Paints is 21%. Returns given by Nestle would be around 22%. Returns given by Divi's Labs would be around 40%. Returns given by Titan would be 22%. So obviously, those portfolios or those portfolio managers who have been proponent of growth and who are focused in some of these companies have really given good returns. But, you as founders of framework QGLP have also always focused on not just quality and growth, but also on price and value. Now, in the future, over the next 5 years, when the liquidity is drying, do you see that era is going to actually kind of bridge the gap, whatever has happened in the past in terms of some of the growth businesses kind of getting too much highly valued? Over to you, Raamdeo ji.
Thanks, Kamal. These waves keep coming, and markets, they keep committing mistakes. Every time, maybe there is no end to new mistakes. I mean, markets have, and a lot of these mistakes are repeated also, in the sense that what happened in 2000, I think it has happened in a slightly bigger scale now in the unlisted markets and even in the listed market for the digital businesses. So the mistakes of the past will not be repeated again in the same form. So whatever mistakes we committed in terms of valuing this, a lot of these so-called hyper growth companies, and people didn't know, including me, people didn't know what is the true value underlying. Only people looked at momentum or price or whatever. And that also includes a lot of growth companies at any price. One of the things, one end was the digital companies, didn't have sense of value, but kept on getting the global valuations and those kind of momentum. Second was that a lot of growth companies, actual growth good companies, they also got priced like way out of sync. So growth at any price. And some of the companies you mentioned, their earnings growth has been very, very minimal. But because of re-rating from 40p to 60p to 80p to 100p, I mean, it looked as if re-rating is like unlimited, irrespective of because they are rare companies, they're outstanding companies. So in fact, these kind of excessive valuation, as the interest rates go up or liquidity dries up, I don't know what will drive that, but that definitely will get corrected in the days to come. Also, the liquidity is one thing. Yeah, good thing that you mentioned. I think the allocation, see what is happening is the funds are becoming larger and larger, but the liquidity of a counter is becoming kind of very restricted, and hence the impact cost or in and out is going to be very high. So the portfolio managers will be extremely careful how much to allocate for individual stocks based on liquidity. Even quite a few larger stocks don't have adequate liquidity to support the allocation in the portfolios. So I think that those things will happen. And I think thanks to social media and a lot of this instant flow of information, the sector rotation will happen very, very preemptively, in the sense that like recession, the fear of recession. I mean, it's just a fear of recession in US, but the second order and third order activity has already happened. Like people have called in what first recession, and then what will be the impact of recession, and hence what will be the multiple of the company. And people have acted also, and allocations have been changed. So I think there's too much of preemptive strike is happening. Sometimes it's right, sometimes it is too much ahead of time. So those things are happening because the information is simultaneously moving all over the world, and the opinions are getting the whole opinion is going one side. So that balancing which used to happen because of inefficiency or whatever, that is not there. So one has to be very careful, and that's where the understanding of value is very important. Because at some point of time, say 7-8 months back, value was half of the price. Today, price is half of the value, and yet there is no taker. So that, that's where the I think some of the adjustment has to happen, and for making, and then in Indian context, like globally, people are saying that don't fight the Fed, but in the Indian context, I would say don't fight FIIs, because they are deciding, because having 20% market of the holding and liquid and all the blue chips, I don't know what is going to happen in terms of their behavior and sustained behavior. We have seen in 10 months unprecedented behavior of theirs in terms of selling. So that brings a yet another type of uncertainty in the marketplace. So you have to also keep, because when you're managing public money, when you're managing private money, probably a lot of these things don't matter. But when you manage large public money, probably these things also come to mind. And finally, I think from here, for a decent return, the holding period may go up. So these are thoughts which I while in last 1 or 2 years, this is what I'm going through.
Sure, Raamdeo. Thank you so much for your insights. Moving on to Prashant. So given, given
a point to that, Bharat here. Kamal, can I just say that?
Please go ahead.
Yeah.
Please go ahead.
Well, I would say what foreigners have done for about a year by consistent selling has made us realize more of our strengths rather than our vulnerability. Usually investing is seeking opportunities out of threats and vice versa. So I really see this as reminder of our emerging strength rather than vulnerability. And to that extent, I look at it this way, that if foreigners have sold so much, then they have a relatively less to sell going forward. And if they've sold so much and Indian markets have really fallen half of what American markets have done, all the formulae and automatic constructs which have been built that if something happens to America, then this will happen to the other markets. I think time has come to revisit this. I strongly believe that in the coming decade or so, and probably decade is a longer number that I'm putting, but I'm hopefully being conservative. I think India will be both in terms of the size of GDP as well as the size of the market, uh, will be amongst the top three in a decade's time. And it will emerge in its own right. So, what foreigners can do, what they've done, and what they will do, I can't predict what they will do, nor I really would try to make a judgment believing that that judgment will be right, because it can't be. I won't know enough to be able to predict that. But I definitely believe that more it goes on that negative territory by their action, greater will be the spring reaction and greater will be the opportunity.
Sure, Bharat, I see, you are relatively more bullish than Raamdeo ji. I will come back again to Raamdeo ji. My now next question to, Prashant, that in the current context, of whatever macro, micro environment we are in, what is your understanding of the correct valuations in the current context? When we say that we are fairly valued after 15% fall, and some of these growth businesses have actually seen maybe a 25 to 30% fall, especially in the IT companies, or maybe even in financial services, or even in consumer discretion. In the overall context, are you comfortable with the valuations currently, or is there a way to find out in a certain, are we fairly valued?
Certainly. No, certainly, Kamal. First, I'll just add that you mentioned in the current context of macro. So the macro has almost always been uncertain. Yeah. And if you just look back over the last 5-6 years, at least 3 distinct times, you can say this is unprecedented level of uncertainty. Remember, demonetization was just 5.5 years ago, late 2016. I mean, for the last time it had happened in the 70s or something, right? That the 100 rupee note was discontinued or something. So people put out all kinds of, phrases of how it's like hitting a cement wall, a fast driving car and all. And people we are just totally, the economy is going to go in tailspin and all. The bear market lasted from November to December 25th or something, from early November to December 25th. And then next year, the storyline changed. The demon actually was good. It is, actually leading to market share gains from unorganized sector to organized sector, so on and so forth, various things. Right? Then obviously we have other things as well, but I'm not talking about the smaller things like GST implementation, or relatively smaller things. At that time, people were making out to be a big. But look at COVID. Last time something like COVID happened was 100 years ago, the Spanish flu in the 1920 or something. The world has never seen anything like that. And what were the, again, comments and in the media and amongst investors was, is going to be worse than global financial crisis. Right? The market bottomed on March 23 to 2020 when there were cumulatively only 5 deaths in India. Obviously, we ended up being with millions of deaths. I mean, who knows what the exact tally is, but you can assume it's in millions. And many million, I mean, probably crores, 50 crores, something like that. Much higher than that, but I'm just hesitant to say because the data is saying something very different. I believe almost everyone has had 80%, 60%, some such percentage has had COVID. On March 23rd, only 5 people had died cumulatively. That day, the number of COVID infections were only 75, and cumulative reported COVID infections were only sub 500 or so. Yet the market recovered and rallied from that point, even though we were all extremely scared about our own lives, as well as obviously the market as well. This year, with the Fed and Fed hiking rates compared to demon and COVID seems like chum change, right? Even if you add the the Russian invasion of Ukraine, people again, last time there was some country attacking the other country was like many decades ago. It's very possible, few months out. You know, we look back and it didn't really change the world that much. Key question that nobody knows the answer to, nor do the central bankers, the bond markets themselves are trying to figure out, and so are equity markets, is whether inflation is going to be sustained and sticky in the developed world, let's say, at the mid to high single digit range, or is it transient and pulls back to low single digits? And the reason that is possibly, that is important was what Aishwarya in the introduction mentioned, that valuation growth and what is the third one? Valuation
Liquidity.
Liquidity. So I would say liquidity, I would put it more as the discount rate or the R in the. So all three are interconnected. First of all, value is equal to cash flow divided by R minus G, R being the discount rate. So liquidity may be one of the elements of the discount rate. In my view, a very small, very, very small element. Discount rate is function of several things, and most particularly and importantly, long-term inflation expectations. So if long-term inflation expectations were to rise, then the discount rate would rise. It's not the near term 1% inflation going to 7% inflation that matters for the discount rate, because value of any company and hence the market, which is collection of companies, is present value of future cash flows of each constituent company. And this is future cash flows into perpetuity. As we all know, Raamdeo ji and Bharat in their portfolios also, 80-90% or more of the value would be in cash flows that the companies would generate beyond 5 years. And even in the beyond 20 years would still be the majority of the value. So what is the discount rate we use in the very long term is really what matters for the valuation. And these long bond rates, if you will, they haven't moved up as much. They have moved up, but not anywhere as much as the fears of the near term and some, let's say 1 year, 2 year have moved up over the last 6-12 months. But what matters is the long term. And long term, discount rates are impacted by long-term inflation expectations. Among other things, most important, I think, is the long-term inflation expectation. Those have been fairly well contained. They've inched up, but they're still fairly well contained. If the current inflation stays sticky for several years, or a year or 2 or 3, then it is possible that long-term inflation expectations start inching up and further. And if they start inching up further, then the long-term bond rates would inch up further. It's all unknown. I mean, that's what makes the investing such a exciting sport, if you will, that it's all in the unknown territory. You have to take it by the day. But as of now, the long-term bond rates are suggesting that while inflation expectations might have inched up, it's not something that is going to go out of hand. And to the extent that those bond rates have gone up, you've seen some valuation correction. And remember, year to date, S&P 500, India's BSE 500 is down only 7.5%. Right? 2 years since the end of 2019, I take that because it's pre-COVID, without the impact of COVID. If you take from the bottom of COVID, it's double and all. Pre-COVID, the S&P 500 is up more than 40%. So we've had 12-13% return. So it's not like the markets have gone down dramatically or anything. I mean, as Bharat was saying, markets can. I mean, if inflation remains very stubborn and things continue to go in the negative direction, then there can be more downside in the near term. But that can't be the base case. You can always spin a very extreme negative scenario, nuclear war scenario or the equivalent in the economy, but those are not the base cases. That is how I would say. So we, as a firm, Vito, always believe that the market is at present time fairly valued, even though it may never be fairly valued. We know that, but nobody knows whether it is overvalued or undervalued. It's like, coin flip. It's never going to be heads and tails both together. I mean, it's always either heads or tails, but going in, the odds are 50-50 of each, either heads or tails. So the reality would be different from being fair valued, but we always assume that every market is fairly valued. It's the individual companies, because even in a fairly valued market, you can have individual companies that are overvalued and undervalued. On average, they are fairly valued, right? So we continue to look for what we believe are great businesses with which are attractively valued or undervalued in the context of a fairly valued market, and we remain fully invested at all times.
Sure, Prashant. Raamdeo ji, moving on to you. First of all, I would want your views on the current market valuations. And secondly, you had mentioned that you believe that now going forward, maybe more of a sector rotation will be more frequent as it was in the past, because maybe cycles are shortening. And wouldn't that be against the philosophy of buy right and sit tight? Because in last decade, actually, wealth creation has happened mostly by buy and hold. Whether it is you or it is Mr. Bharat Shah or Mr. Prashant Khemka, many fund managers, they've always taught us buy right, sit tight, or kind of buy and hold in long term, longevity, and have temperament to hold long term. So these are the two questions: one on valuation, the second on this aspect.
So I think valuation is not that big a problem, because we are looking at about anywhere between 825 to 850 rupees kind of a number EPS for Nifty, and that keeps changing with the metal price and all those things changing. But today morning only I had a discussion with my head of research, and he was saying that, sir, this quarter is not showing that much cut in the earnings in aggregate. What is a gain for somebody, it is a loss for somebody. So broadly they are still in 850 camp. So looking at that possibility, I think we are not that much way off. I mean, it's not grossly undervalued kind of market, nor it is a eye-popping high multiples market. We have seen recently 30-32 P multiple also, and right now if you are looking at current year closer to 20 times, I think that's fine. I mean, maybe it can come down to 18 or something like that, but that's not much to say about the aggregate market. So I would think that we are at very fair valued average valuation market. Now a lot of things are happening in terms of oil price, in terms of this so-called Fed action, monetary policies all over the world. So those things can have short-term impact, but on aggregate basis, 1 time GDP, 20 times P multiple, they don't seem to be outlandish. So that is about the valuation. As far as sector rotation, I mentioned that in the context of the things which we are hearing, about, I mean, more about the market phenomena, not about what we do. We will always stick to what businesses we understand and the companies underlying them. So our allocations across the businesses will be far more sticky, and companies also. So we'll keep following QGLP framework, and within them, whatever stocks come, buy right, sit tight type of situation, where many times we have suffered by holding it for much longer period than what the company, because company it starts very fairly, and then after 3-4 years, what happens is it becomes very expensive. And in terms of portfolio also, when you buy and hold, say you started with 3-4% position, it goes to 10, 11, 12% position. And that's where I think that over staying with the stock or over allocate, over getting allocated a lot bigger than what are the starting point or what is the fair level. I think those things we need to change. But broadly, what I'm saying is that in index, there could be a lot of churn from this sector rotation. And but our style is not to follow too much of sector rotation. So I don't see much change in our style, but challenges will come to buy and hold kind of strategy from sector rotation at the marketplace. That's what in that context I was saying.
Sure, sure. Bharat bhai, moving on to you, you have always been, again, I would say, proponent of the fact that knowledge is important in equity markets. I started this session by saying that we are doing these sessions to kind of for the sake of knowledge. But you also mentioned that more than knowledge, because knowledge can help you select a good company, and today it is known to everyone that these are the set of good companies. It is more than knowledge. What matters is temperament to hold it during bad times and hold it over a longer period of time and kind of gain for that longevity, for getting that 10 times or maybe 20 times returns. So the temperament aspect that you have cultivated within your fund management team, or which is maybe as an attitude within yourself, how does one as an investor kind of cultivates that? And do you still believe over next 10 years, the same process of wealth creation based on which you have created wealth in the past, which is like holding on long term, will kind of be making in the future as well?
So, Kamal, if on the first question, if you look at knowledge and intellect, markets are never short of intellect. Markets consist of very bright people, some extremely bright, some sufficiently bright. So if IQ is the only advantage you have, it is an insufficient competitive advantage. Because in marketplace, there'll be enough people who would represent intellect and brightness superior to you. So if algorithm and arcane kind of solutions is your strength, it's unlikely to be working that way. Therefore, the real strength.
Bharat, we've gone on mute.
My apologies. Sorry, I was on mute. My apologies. So I was just saying that markets, intellect and knowledge probably are not sufficient competitive advantages, because marketplace is full of very bright people, and subnormal intellect doesn't survive in the market, and therefore it is easily thrown away. If the competitive advantage is only IQ, then again it is going to be woefully short, because there are enough bright people who can beat you on that. But where you probably can have strong competitive advantage is in the EQ part of your personality, if you have one and you develop it one, which may consist of things like discipline. It may consist of things like psychology and resilience in the mind. It may consist of things like wisdom. And I think it is these EQ components which have a far greater chance of taking you over the final crossing line in a relatively smoother and more elegant way, and with superior overall outcomes. Therefore, I certainly have no confusion about that particular aspect. That doesn't mean that you choose badly or you choose mediocre investments and hold them for long term, they will turn into diamonds. Clearly not. You have to choose well, but you must have an ability to deal with the machinations of the markets. Markets are not in a business of pleasing you. Markets are not in a business of gratifying you. And markets are certainly not in a business of making you rich simply because you put money in the markets. In fact, markets are trying to snare you, to trap you, to push you down. It is your job to keep your psychology intact, your mental resilience intact, to fight with those machinations and come out on the other side well and hearty. And therefore, role of discipline, which is basically to recognize what is good and to remain on that path and to not get distracted. Role of resilience and psychology, so that you don't fall for the trap and you remain on the path again. And the role of wisdom to recognize that these things will happen, will continue to happen, and yet you have to find your way through and remain steady. Therefore, knowledge and intellect have very sharp cutting edge, but it shows the path ahead and it shows the analytics behind it. But wisdom illuminates your path all through and lets you go through the tortuous path of investing without accidents. Therefore, that certainly remains foremost in my mind. Your second question, I'm sorry, Kamal, but if you can
The
repeat.
question was the longevity and buy and hold. Do you still believe in the same over the next 5 years?
I mean, why about 5 years? 325 years of recorded history is anything to go by. These are very technical, nagging doubts that come to our mind when markets are not doing us a favor. But if we revisit history all the time with every twist and every difficult moment of the market, then fundamentally we are not designed to be able to deal with the machinations of the market well. And therefore, again, there is very little substitute for discipline. There is very little substitute for long term. But long term has to be intelligent long term. It can't be mechanical long term. That intelligent long term has to be in the context of whether what you thought about a business continues to remain so or not, whether what you thought about what will evolve the value path, whether it continues to do so or not. I mean, just because you store pebbles for a long period, they don't turn into diamonds. Therefore, you need to choose the right ones, and then remain long term. It is the combination of the two which is important. Therefore, quality, no substitute for that. Long term and intelligent passivity, where you are able to suffer the insults of the market without getting distracted from the task. And while remaining mindful of the mathematics of the valuation, at the same time, whether the business is continuing to evolve or broadly in the direction in which you thought it would.
Right, Bharat bhai. Thank you so much for your wisdom. So we have now last set of 3 questions over last 8 to 10 minutes. I would request, relatively shorter answers so that we can cover it within time. Moving on to Prashant, what are your views, after this recent correction, if one has to allocate money between India and US, what is relatively more attractive? And how would you kind of, see this set of questions?
You're asking me, should I go ahead?
No, I'm asking Mr. Prashant Khemka.
Oh.
Certainly, Kamal. First of all, just a minute on the prior question. I won't take too long. Just on the buy and hold, and I might be recapping some of what Raamdeo ji and Bharat bhai said. How we approach is that whatever holds true for buying a company holds true. The same approach should be applied to selling a company as well. So we've often talked about buying great businesses or investing in great businesses at attractive value. The two elements are business and value. We are looking for the most powerful combination of business and value when we're buying, and at all times what we're owning in the portfolio. If this combination of business and value deteriorates, either because the greatness of the business is getting diluted, apologies, I have a bad throat, either because greatness of the business is diluted, or the valuations don't leave any material upside, then it may be a reason to trim or exit. And hence we basically have shied, while you put it as a buy and hold, we basically shied away from saying that we follow a buy and hold approach because, as Bharat mentioned, sometimes things may not go as we are expecting. It's a probabilistic world. Newspapers were great businesses for 100 years and made a lot of money. But when internet came in, those who were not quick enough to react and or understand, react or quick enough, I would say, to understand the big implications, and for those whom the buy and hold kind of impregnation in the mind kept them in the newspapers for much longer than what ought to have been the case, destroyed tremendous amount of wealth. I've seen that in US at the start of this century and other markets as well. So now coming back to your question of US versus India. See, I think, as I was saying earlier, in my view, all the markets, just as I said, Indian market is fairly valued at all times. Similarly, I believe all markets are fairly valued at all times. At a macro level, nobody can add value by trying to call undervalued and overvalued markets. Generally speaking, if you look at 30, 40, 50, 60, 70 years time frame or 100 years time frame, various markets have, with some rare exceptions from a point to point, they've generally delivered returns in line with the nominal GDP growth of the country plus the dividend yield. If you look at this century, over the last 22 years, last I saw US and India both had delivered 5 to 6% return in dollar terms. India had delivered 6% return, US had delivered 5% return. Fairly small. So I think the returns worldwide from the markets would be in a very fairly narrow band going forward of mid-single digits. Where India scores high is in the opportunity to add alpha. Because US is a very efficient market. If you are top decile in US, you might add 1% in alpha, right? If you're top decile in India, you can add 5 to 8% of alpha. So a top decile manager in US, and we are just talking dollar terms, everything, I can convert into rupee as well, but dollar terms, let's say mid-single digits, if you go to take as a return from the markets, dollar terms, US market gives 5%, you add 1% alpha with the top decile manager, you get 6% return. Assume for a minute it's net of fees, even though in US it's challenging to generate 1% at top. And in India, even if you take 5% alpha, that would be 10% return at a top decile manager level. So markets might deliver similar return, but a top decile manager in India can deliver much higher return because of the inefficiency of the Indian market. And this is in dollar terms. In rupee terms, you can add 4%. So in US, you can generate maybe closer to 10% return in rupee terms. In India, it can be more mid-teens with a top decile manager. Obviously, top decile manager, you have to identify, and there remains risk that we are to consider as top decile doesn't turn out to be top decile going forward. But that would be my view on why India, for a total return perspective to investor portfolios, can deliver higher returns.
Sure, right, Prashant. Thank you so much. Moving on to Raamdeo ji, you have 1 minute. I just want to know from you, over last 2.5, 3 years, or whatever we have seen, in market in terms of movement, if you could just give us a perspective of any 1 or 2 or 3 stocks that you would have added in your portfolio, apart from Motilal, in your personal portfolio, if you can give us some guidance, any type of business model or any business or any company out of top 3 stocks that you would have added recently.
Actually, I don't buy direct stocks in my portfolio, so I buy into our own schemes, private equity or public equity, which is being managed by Motilal also. That's the 100% allocation of mine, Motilal's money. So actually, I don't have any direct stocks in the portfolio of my own personally. So there is no question to say that this is the stock I have bought or sold in my personal name. No. But through the wealth creation studies, the last study we did about these digital companies, they seem to be they will as a category, all the online companies, digital companies, they are still struggling with the business model, and there is a lot of discussion and uncertainty about the who is going to be the winner. There are two, three things about that. One is that they are going to become very large companies in next 10, 15 years. So the opportunities will come up for sure there. Second, right now, the business model is not yet settled in terms of profitability. There are turnovers, and hence even the valuation metrics, whether you should look at price to sales, price to book, earnings are not there, so price to earnings is irrelevant. So those things are there, and even globally, since these companies are being hammered big time, so you don't know where the value lies. Price, of course, everybody knows. So I think there, in this uncertain environment, at some point of time, it might throw some good opportunity to look at one or two stocks which one understands very well. Maybe not allocate too much, but start with a percentage, 0.5%, and start learning them. Because I am of the firm view that in next 10, 15 years, one category of very large stocks, because in this category, you're not going to have too many companies, like say delivery. So there'll be only 2 companies. And even in those 2 companies also, there'll be one which will be disproportionate of the size. So my sense is this is one category which is worth watching. Right now, a lot of uncertainty is there. And maybe you might get some unusual value in the days to come. So that's the only segment I would say is a new one for me.
Sure. Thank you so much, Raamdeo. Last question for this session, and we have 2 minutes. Bharat Bhai, from you. So, what we want to know, you kindly, if you can tell us 3 factors that make you confidently say that we are in this golden decade.
Well, one deep structural economic changes we have made, whether we talk of GST formalizing businesses, Real Estate Regulation Act making real estate a healthy word, Insolvency Bankruptcy Act taking time, but at least moving in the right direction. The transparency of the digital systems, direct access, many of the deep economic changes which have been brought about. Secondly, government has been very clear now, apparently more and more, especially over last 2 years, that government doesn't want to be player. It wants to be a catalyst, and the field has to be, and the baton has to be carried on by the private sector, which is the way it should be. Government should set the rules, observe the fairness of compliance with those rules, but the players have to carry the baton ahead and win based on their strengths. Third set of factors, systematic decline in the cost of capital which has occurred while we have been going through the pandemic time, great digitization adoption, which makes businesses efficient and more productive and more profitable. The way payment systems have been digitized and revolutionized, or the entire finance range of opportunities which is waiting to be revolutionized. Therefore, the marriage of technology with manufacturing, agriculture, with finance, education, health, whatever, logistics, is a huge draw. The startup ecosystem, while many may fail, some may fail badly, but some will succeed, and they represent a powerful thrust ahead in innovation as well as entrepreneurship, 2 essential ingredients for value creation. The business is moving away from China, the supply chains getting woven away from China. Earlier, 4, 5 years back, it was tentative and more like a risk reduction. I think from pandemic onwards, it has become strategic imperative for all. And I think based on the recent issues, it has become a strategic imperative. And therefore, many businesses will benefit from that. We have done our own homework as well, production link incentive schemes, all if it plays out well, then I think manufacturing is a scope to be resurrected in this country, which it deserves to. And finally, I would say the real power comes when you go through a huge challenge of pandemic, and yet as a country, as a society, as people, as businesses, as entrepreneurs, you feel more confident emerging on the other end. I think that's a true test of belief about the future. Without that belief of the future, there can't be any growth, there can't be any prosperity, there can't be any optimism, and therefore there can't be any investing. I think the way we as a country, the people, the businesses, the entrepreneurs, and indeed investors have dealt with it, I think it gives a tremendous confidence to deal with the challenges of the future. Therefore, plenty of factors, plenty of issues, but I think after one can say the character of the country, the character and the capability of the country, I think is something which is at the forefront. And India has always been very entrepreneurial, very capable. Now I think favorable firmament and the rules of the game are increasingly getting in place. Therefore, the growth has to be virtuous rather than episodic. It can't be tactical, it will be strategic. And apart from it being stronger in quantum number, I think qualitatively the growth ahead will be durable, predictable, simpler to analyze and understand, and therefore more value creating. Therefore, good businesses will thrive and do wonderfully well. Quality entrepreneurs and promoters who have capability as well as discipline and governance will do phenomenally well. And investors who are patient and quality and long-term oriented and disciplined, I think it will be lifetime of value creation ahead for a decade, longer than that, much longer than that. This is our time under the sun. When there is an opportunity, don't look for gift horse. Doubts, concerns, skepticism, worries are a natural part. It's a defensive mechanism, protective mechanism. But when you unduly apply that simply because prices are volatile, then I think you're not doing investing. You're merely dancing to the tune of the markets. And I think opportunity is here and going to be there tomorrow, day after. We have to recognize and remain engaged. And I believe it is a lifetime opportunity.
Thank you so much, Bharat Bhai. We come to an end of this session. In the interest of time, because the next panel speakers are already waiting, if I had more time, I would have spent a couple of more minutes to ask questions from Prashant, you and Raamdeo ji. But I think the entire session has given us kind of reiteration that valuations are fair. We need to keep a long-term horizon. Equities as an asset class has always outperformed and will outperform. These are the times of we to remember all these things. Thank you everyone once again, and back to you, Aishwarya.
Thank you very much, sir. And I'd like to say thank you to the esteemed thought leaders for such a wonderful and enlightening session.